My name is Susan Solar. I lead the Digital Insight Labs team, and this is part 2 of my talk about what's shaping the future. In part 1, I talked about countries and people shaping the future. In part 2, I took a look at what's happening in Fintech. Fintech is tapping into the possibilities technology opens up, breaking free from legacy constraints and traditional constructs, and responding to the problems and needs and uncertainty ahead. Fintech is responding to the distrust and the opacity in traditional systems of managing money, the transactionalness of banking and money management. I want to say again up front that I'm still going to do a lousy job of recognizing the many sources I pulled from to create this talk. If you search on any of these sources of articles, podcasts, and videos, you'll find the topics and the ideas, the research reports, and the stories I cover, and again, the brilliant people who created them. Inflection points and trends, and I'm going to spotlight some examples. First, a look at some inflection points in play. We are seeing the shift from digitization of existing banking products, for example, moving account or loan applications online, to digitally native experiences like unleashing AI to assess loan worthiness. Many fintechs started with a focus on a specific problem with a point solution, but once they've established themselves, they're looking to expand what they can offer their customers by either building, buying, or partnering beyond their initial use case, as you can see in some of the examples here. Out the gate, fintechs were considered a threat to traditional financial institutions, but now we're seeing a shift from competition to much more partnership between startups and financial services. Looking at global VC investment, a lot of money is flowing into digital lending with a focus on financial inclusion, especially in the United States. Across fintech, there's also a focus on how to create financial stability, investment plasticity to fit the mold of the investor's values and interests, and the idea that you don't need a traditional bank anymore with the rise of challenger banks. Themes that run across these trends are trust, transparency, and the inclusion or democratization of these services. Let's look at some specific examples. Debt. In part 1, we looked at some of the massive debt we collectively owe in the United States, alongside increasing costs like healthcare and education and wage stagnation since the 1970s. Established institutions rely on FICO scores and traditional methods of determining creditworthiness to minimize lending risk, which leaves out a lot of people who are responsible with their money. By learning a little bit about potential borrowers and applying AI, fintechs are tackling lending of all sizes. Affirm offers payment plans for buying and travel with transparency about interest on payments and no penalties for late or early payments to align its business incentives with the customer's best interests. Credit Karma is well established with 80 million subscribers and claims 1 in 2 millennials use their service to determine their credit score and choose the best credit card for them. As their customer base matures, Credit Karma is expanding their loan portfolio as well. Tally is promising automated debt management. They give you a line of credit at a low interest rate, which you use to pay your high-interest credit card bills on time while still getting the rewards benefit of the credit card. Earnest and SoFi both started with a focus on student loans and are broadening their loan portfolios as their new graduates reach different life stages. Across the Pacific, Alibaba is scoring how responsible and reliable citizens are based on their online, offline, and social behavior. Through Alipay, Alibaba has access to a vast amount of data about customers, which is used to determine not just whether you qualify for a loan, but what insurance rate you might get and even who you get to date. In part 1, we also looked at what a large percentage of the economy is made up of gig workers, 34% today, expected to grow to 43% in less than 2 years. Even and Earn-In are alternatives to payday loans and overdraft fees directed at workers. There are over 200,000 Walmart employees using Even to get their paycheck on demand, which they can then cash at Walmart. No hidden fees, no interest payments. Earn-In pays your check based on a photo of your timesheet, and you pay what you think is fair. There's no mandatory fee and no interest. Instant and Gusto focus on small business employers, Instant offering instant pay and Gusto also offering HR and benefits. According to a study by Common Sense, Out of Duke University, who we've worked with in past projects, people would give nearly $10,000 of their yearly income to switch to a consistent job with dependable pay. Steady is one example of a different approach to steady, predictable income, supplementing variable work hours with more choices for making an income. Today, a lot of money is still tied up in 401ks and other traditional investments. There are 54 million American workers participating in over 500,000 401k plans, and there's about $5.3 trillion in just 401ks and a total of about 28 trillion in U.S. retirement assets. But as we talked about in part one, those assets will start to move from one generation to the next. These days, there's no one on the New York Stock Exchange floor trying to trade stock, but for a long time, those legacy costs were still baked into trading fees by brokers. And the complexity of trading, minimizing fees, and predicting the market is largely handled by algorithms. There are loads of general robo-investing platforms out there. Wealthfront and Forward Lane are some examples. Robinhood is an example of a consumer stock and now crypto investment app that capitalizes on these developments, letting you trade stocks for free and serving up curated recommendations based on your tastes, borrowing a page from the consumer space. In part one of this talk, we saw that millennials expect where they invest to reflect their values. Swell, Motif, Open Invest, and Hedgeable all take different approaches to impact investing while maintaining returns that are on par with the market. You no longer have to compromise on returns for your principles or compromise your principles because of the rigidity and limitations of 401ks. Another newer form of investment is through P2P lending. By using AI to determine whether an individual or a small business is a good loan prospect, and by pooling money and spreading across loans, companies like Funding Circle, Prosper, and Upstart manage risk and predictability of returns. And various forms of crowd investing have opened up or are on their way to opening up previously exclusive assets and asset classes like pre-IPO, early or late-stage startups via EquityZen or Our Crowd, or commercial real estate through early shares or Cadre, Peer Realty, and many other examples. On the theme of upending traditional models, let's look at challenger banks. I'm using challenger bank broadly to include all the non-traditional businesses trying to eat banking's lunch. In the fintech startup world, Cogni is promising intelligent banking for the gig economy, with rewards for debit spending, recognizing the debt-averse generation, offering up to 40% cash back on hotels, 12% on everyday purchases, also recognizing and digitizing the saving habits of millennials. In many conversations with young people and couples, there's a strong prevalence of some form of the envelope method of saving, naming and bucketing money for a specific category of spending, like this is my envelope for car insurance or date night. Movin is acquiring a legitimate bank in the U.S. to officially become a challenger bank, in addition to continuing to expand their software banking platform internationally on a separate path. Borrow Money, another fintech, is applying for a bank charter. European digital-only banks are also coming to America. N26 raised $160 million for U.S. expansion. Revolut and Monzo are also on their way. Monzo is creating a marketplace with an open platform that any service can plug into, the App Store model for banking. N26 also has a partnership with TransferWise to offer fair money exchange rate. TransferWise is a great example of a fintech success story. They've quadrupled revenue in 2 years, reaching $151 million recently. But it was started the way a lot of startups begin, based on a specific irritating pain point for the founders. Taavet and Christo, who are both from Estonia, had this problem. Taavet was the first employee at Skype, and he was paid in euros, but he lived in London, and he needed pounds to pay the bills. Christo worked for Deloitte and lived in London. He got paid in pounds, but he had a mortgage back in Estonia. He needed to pay in euros. Every month, they moved their money the old way. It was wasting time. It was costing a lot of money. So they invented a really simple workaround, which was basically exchanging their pounds and euros between them. And that led to this business that to date has been used to transfer over $4 billion. And if you go into a small bank in Europe, the bank will recommend TransferWise over their own transfer services. Vodafone, which I talked about in part 1, looking at Kenya, is essentially a large central bank, since you have to transfer money to Vodafone to turn it into M-Pesa, which is what nearly half of Kenya's GDP runs on. Goldman Sachs is also trying to elbow their way into this retail space with Marcus, which is a pretty thoughtful approach to lending, stepping into the customer's shoes and understanding what about loans makes them so hard to decipher and solving for that. Amazon, of course, doing all kinds of things that look like banking services, and Facebook, that's a topic for another day. With that, I'm going to wrap up part 2 and tee up part 3. In part 3, I'm going to look at tech that's shaping the future: artificial intelligence, quantum computing, VR, AR, and mixed reality.